I'm not going to go through each formula individually. Okay. I think it's better we just talk about the themes again to make sure that you're clear. And then we just move on to practice problems. So again, this first theme is ability to pay current liabilities. Uh, the main theme, I guess, was to pay off liabilities in general, but there is a number of them that were just related to current liabilities that we talked about. So if you remember, the most lenient was this one, where we took a ratio of all current assets to current liabilities. That was the current ratio. This next one was a little more stringent because we got rid of the less liquid current assets. Okay, because for example, inventory, it may take a long time for that inventory to turn into cash. So if we needed cash right away to pay off our current liabilities, inventory is maybe overstating how safe we are. So we remove inventory from the ratio. So we see it's only cash, short-term investments, and receivables. Okay, there's no inventory, there's no other current assets. So this was going to be so this is a subset of current assets, right? So this is the asset test ratio by definition will be equal to or lower than the current ratio. Okay, it's only equal if we had like no inventory or no other current assets, but it will be lower because it's more stringent. It's taking only the most liquid part of our current assets. And then even more stringent than that is just taking cash. Okay, so then we get rid of short-term investments, we get rid of receivables, and we just look at how much cash do we have on hand to pay off our current liabilities. Okay, and then working capital, just the definition is current assets minus current liabilities. Okay, so there's a lot of detail of working capital, why it's important. I think it's like a little more advanced. So I think just for now, just know the definition of that. Ability to sell merchandise inventory and collect receivables. So inventory turnover, these two are related. They're just kind of a function of one another. Um, Basically, seeing how long it takes to sell inventory on average. Gross profit percentage, which has to do with that buy low, sell high for a merchandiser. Um, Accounts receivable turnover ratio. This has to do with how quickly we're able to uh, collect our receivables. And then day sales, these two are also kind of functions of one another. Okay. Ability to pay off long-term debt. This is another theme related to uh, leverage. So the debt ratio, which was total liabilities divided by total assets, it's actually related to this debt to equity because remember, this is L over A, this is L over E, but we know that L, E, and A are all related because A equals L plus E. So, they're all related. Uh, there are different ways of showing how much leverage there is on the balance sheet. It's not like they're saying two separate things. It's just a different, it's a different formula, but they're related to each other. There's one-to-one correlation. A change in the debt ratio will change the current ratio or the debt to equity. Okay, because they all move in lockstep with each other. Um, and then times interest earned. This is the debt coverage ratio. We saw how much earnings there are that support the interest payment. Okay, so there's many themes of this coverage ratio. This is like a very basic one. Because again, interest expense does not include maturities, right? A bond maturity is going to have this big balloon payment that you got to come up with. Okay, so this interest earned ratio is is a very simple uh, ratio that doesn't tell the full picture, but it could be somewhat useful. Okay, it's a starting point. Yeah, I guess you can say if you're not even good on this, you're cooked, Like the details don't matter. Okay, so this is like the minimum first step thing to make sure you can at least service the interest. Okay, profitability, profit margin ratio, return on assets. Again, all the formulas are here for you. Okay, so you can just refer to the slides. But I guess the important thing to remember that these are all trying to answer this question about profitability, bottom line, how much return profit is the business generating for the owners. And then valuation. So price to earnings ratio, again, this is going to be related to the market price per share, the dividend yield. Now, we had that, we had for bonds, that discounting of cash flows to get the bond price. You could kind of do that if you knew how much dividend income you're getting per quarter or per year or whatever, and you can do a similar analysis. So dividend yield is a potentially useful measure as a way of valuing the stock. Okay, but I guess for now, again, that's like a more advanced topic of business valuation is like a whole other topic. But I think just know the formula for dividend yield. Um, it's basically a way to see uh, if you're paying $10 for a share, how much income will you get from the dividend? Okay, so you can see annual dividend per share divided by the market price. It's going to get you like a yield, similar to investing in a bond. And then dividend payout, um, dividends paid divided by net income. If this ratio is 1, what does that mean? Yes, it means that however much net income, however much profit the business generates, it's not retaining any of it. It's paying all of it out to its shareholders. Can this be greater than 1? Or it can borrow money. You can borrow and pay a dividend. Some businesses, believe it or not, are crazy enough to do this. If this ratio is greater than 1, it is unsustainable. At some point, the business will go out of business because you cannot pay out more profit than you're generating. Now, some businesses are like, well, we had a bad quarter, a bad year, so we'll pay out more than we earned this quarter. But structurally, it cannot be for a long period of time greater than 1 because you cannot pay out to your shareholders more than you're earning. Berkshire Hathaway, Warren Buffett's company, the payout ratio is 0. That company does not pay a dividend at all. It chooses to retain all profits. It's been extremely profitable over its like 40, 50-year history, but it's chosen to reinvest all of its earnings back into the business. And that's worked out for the shareholders because Warren Buffett is a far savvier investor than the common person. That cash coming into your bank account, it probably would have been spent on something. But instead, Warren Buffett took that money, invested in some new business, some other investment, and he compounded it for 50 years. And if you had put $1,000 into it back then, you'd be a multimillionaire. Okay. So a dividend payout is not necessarily good if you have smart people running a business. You actually want them to keep the earnings in the business and reinvest it.